Welcome to the Deep Dive. Today we're cutting through some market noise, really digging into a very abrupt, pretty fascinating shift we saw recently.
Yeah, that last week of October was something else.
We're drilling deep into the analysis from D Investment Enterprise and D Publishing Group, specifically that LoopMarket Weekly Report by Devin McClarty, covering October 27th to the 31st, 2025.
And that week was all about what they've termed the magnificent reversal. You had the market stuck in this defensive mood for weeks, and then boom, a really powerful rotation back into growth.
So our mission today is pretty clear. We need to figure out what exactly triggered this pivot back to risk on. Follow the money, see where the institutional capital went.
And crucially, use their proprietary structural intelligence framework. That's key.
Right. To figure out if this was just, fleeting sentiment or if there's a real shift in institutional thinking underneath it all.
McClarty's team summed it up well. They said, this rotational data confirms that we're in a magnificent reversal. Tech reclaimed dominance, energy rotated up, and defensives got drained. It's pretty textbook, actually. High velocity.
Okay, let's unpack this then. A reversal that sharp, that decisive, it doesn't just happen, right? There must have been some serious forces coming together. What exactly lined up to make institutions feel confident enough to jump back into growth like that?
Well, the analysis points to three main macro forces converging, sort of creating the perfect conditions for this. Think of them as three pillars supporting the move.
Okay, pillar number one.
First up, the constant background noise, the Fed pause narrative. The latest PCE inflation data, it came in sticky, it held near the Fed's target, didn't really accelerate much.
So not necessarily good news on inflation, but not worse news either.
Exactly, and that reinforced the market's belief that the Fed was probably done hiking rates, or at least pausing for a good while. That takes valuation pressure off growth stocks immediately.
Yeah, that makes sense, because future earnings look healthier if rates aren't constantly climbing. So Fed pause expectations? What's pillar two?
Pillar two was mega cap earnings momentum. And this wasn't just okay earnings. It was real strength from the giants. Amazon, AMZN jumped, 10% that week?
Wow, 10%.
Yeah, huge. Mostly driven by their AI and cloud results. Apple, AAPL, also chipped in, up about 0.5%. It was a powerful reminder that these, durable growth stories are still out there, even with macro uncertainty.
So strong earnings from the big guys acting almost like defensive growth plays. Got it. What was the third force?
Number three, China trade relief signals. There were some pretty positive signals suggesting tariffs might ease up. That's always good news for global trade supply chains.
Right. Helps commodity sectors especially.
Definitely. So you combine clear Fed path, solid mega cap earnings, and better global trade vibes. Well, that's your recipe for risk on reversal.
Okay, this is where it gets really interesting for me. We know why they might have moved. Now, let's follow the money. Where did it actually go? The sector flows should give us the hard data on this shift in risk appetite.
Oh, absolutely. The capital flows paint a very clear picture. The top three winners really tell the story of risk on leadership that week.
So who was leading the pack?
Top of the list, technology, XLK, it gained 2.8%. That's directly tied to those big AI and cloud narratives we just talked about. Investors basically decided that momentum trumped any lingering rate worries.
Okay, tech number one. Who's next?
Next was energy, XLE. It was up 2.4%. Those trade de-escalation hopes plus strong global demand sent oil prices soaring up about 7.5% in just that 1 week.
7.5% on oil. Wow, that pulls the whole sector up.
For sure. And finally, industrials XLI also had a strong showing, up 2.1%. Better supply chain confidence, the general pro-growth rotation, it all helped manufacturers and logistics firms.
But, the report highlights something crucial here. It's not just about who won, but how those wins were funded. For a real risk-on move, money has to come from somewhere safe, right? So where did institutions pull the cash from?
That's the key insight. They used the defensive sectors quite literally as a funding source. The analysis shows sectors usually seen as safe havens were actively sold off. Specifically, utilities, XLU, down 0.2%, and consumer staples, XLP, down 0.6%.
Hold on, though. Minus 0.2%, minus 0.6%. Those seem like pretty small dips. Why call them a funding source instead of just, minor profit taking?
It's about the pattern and the scale for institutional portfolios. They rely heavily on those stable, cash-yielding defensives. When they need cash fast to rotate into surging tech names like, you mentioned HPE, up 2%, EMPH, up 1.8%, they systematically sell their safest, most liquid assets.
Okay. So it's less about the percentage drop and more about the act of selling safety to buy risk.
Precisely. It's like raiding your emergency fund to chase a hot stock tip. It's calculated, it's fast, and it signals strong, maybe short-term conviction that they couldn't miss out on the reversal. They saw an urgent opportunity.
Okay, so the data seems consistent, strong rally, fueled by selling defensives, seems like high conviction. But this is where the de-investment analysis gets, well, complicated. We have to shift from this bullish sentiment to the underlying structure.
Exactly right. You can have a party on the trading floor, but if the big money, the long-term strategic accounts, haven't fundamentally changed their stance, that party might not last. That's where their Structural Intelligence Composite Index, this ICI, comes in.
The structural index, right. So what did it show? Because based on everything we just discussed, Amazon plus 10%, tech surging, defensives being sold, I'd expect that index to be flashing bright green, full risk on.
And that's the core contradiction, the really fascinating part of the report. Despite that powerful bullish reversal, despite the clear rotation, the structural index came in at 67.5.
67.5. Where does that fall on their scale?
That puts it firmly in the neutral to defensive band. That band runs from 60 up to 74. So not outright bearish, but definitely not bullish. Cautious.
Wait a minute. How is that even possible? Tech is flying, money's rotating aggressively. How can the underlying structure still be rated as cautious or defensive? Is the index just lagging behind the market moves?
That's what they call the vault signal. And no, it's not lagging. It's measuring something different. It's measuring controlled distribution, not panic selling, but not panic buying either.
Controlled distribution. Unpack that for me. What does that mean in practice?
Think of it like this. The reversal, the rally, that was a sprint. But the structural index suggests the big institutional runners, while they join the sprint, still have their long-distance walking shoes on underneath. They were opportunistic, took advantage of the sprint.
But their long-term gear, their overall posture remained cautious.
Exactly. Controlled distribution means they likely use the strength of that rally, the higher prices, to methodically sell some exposure, maybe in higher valuation growth areas they felt were getting frothy, or perhaps to lock in some profits and move into cash-like instruments.
So they were actually reducing their overall risk profile during the rally, using the price strength to lighten up strategically.
Precisely. Managing risk into strength. It's a calculated retreat from peak risk. They participated tactically, sure, but they didn't shift their whole strategy. The underlying structural risks like unresolved inflation, the Fed's ultimate path, and those haven't gone away in their view.
Oh, okay. That completely changes the interpretation. The magnificent reversal wasn't a green light. It was more like a temporary opportunity to adjust positioning within a still cautious framework. So what actions does a 67.5 ACI reading actually dictate for a big institution?
It mandates prudence, protection. The report's recommendations are clear. Protect your cash flow. Hold off on big expansion plans that need cheap money. And wait. Wait for verified core PCE data that proves inflation is truly under control before making bigger, longer-term commitments.
Which brings us back to their closing thesis. The market didn't break. It pivoted to protection. That's why we say structure is winning over sentiment. Professionals are playing the longer game here.
Yeah, they're not chasing the highs blindly. They're using the volatility to get better positioned, maybe even de-risk a bit where needed.
Okay, so that leads us neatly into part 4. The look ahead.
Yeah.
This current setup sounds really fragile, highly sensitive to the next batch of economic data. For you, the listener, what should be on the radar for this coming week, November 3rd to 7th, that could actually nudge that structural index?
Yeah, this structural watch list is critical now. First up, Monday, November 3rd, ISM Manufacturing PMI. This is your gauge for industrial health. 50 is the magic number.
Above 50 means expansion, supports the bulls.
Right. But if it dips below 50, expect defensives to catch a bid almost immediately. That could pressure that 67.5 reading downwards.
Then midweek looks busy.
Very. Wednesday, November 5th, you get two big ones. ISM Services PMI. Services inflation is the sticky part, so if this comes in hot, say above 53, it reinforces the higher rates for longer idea, which isn't great for growth valuations.
Jobs number.
Same day, ADP employment. It's a labor market proxy. If it's weak, that might fuel hopes for rate cuts, which the market could like short term. But a strong number supports bond yields staying high, potentially capping the rally.
And then we need to look overseas and at a specific sector.
Yep. Thursday the 6th, the Bank of England rate decision, important for currency markets. If they sound hawkish, it could put some upward pressure on the US dollar, which can sometimes be a headwind for US stocks.
And earnings?
Also Thursday, Albemarle, ALB earnings. They're a big lithium player, so their results are kind of a pulse check for the whole EV and green tech space. A
Yeah.
positive report could give that theme a much needed boost.
Okay, so wrapping this all up, the magnificent reversal. It was real, it was powerful, driven by data points we could see. Capital definitely rotated.
But
But
it
back.
happened inside this larger, structurally cautious framework. The big players, measured by that SICI index, are still acting defensively overall. They use the rally, they didn't necessarily fully buy into it long term.
So the key takeaway for you listening is understanding that the difference between a short-term tactical move and a genuine long-term strategic shift. That's crucial right now.
Absolutely. Distinguishing sentiment from structure is the name of the game.
Which leads us to our final thought for you to chew on. Given that institutional structure is still sitting there at 67.5, neutral to defensive, which piece of upcoming data do you think is most likely to give the clarity needed to finally push that structure out of its cautious band? Is it the manufacturing data, the jobs report, or is it really just waiting for that definitive core PCE inflation print?
That's exactly what the pros are weighing right now. How you answer that likely shapes how you should be positioned for the next few weeks.
Lots to think about there. Thanks for joining us on this deep dive into the McClarty Report and that magnificent reversal. We'll catch you next time.